Hi, I'd like to welcome everybody to another edition of Thompson Wealth Management Solutions Fast Five. And before I get too far into this, want to wish everybody a happy holiday season. Christmas will be upon us soon. I know it's busy. So if you have some end of the year planning you need to do or some help with anything, please don't hesitate to reach out. Great Fast Five today. Really happy to have Matt Forsdick here, Vice President with Brookfield Oaktree Wealth Solutions.
All opinions and views expressed by the speakers are not representative of views and opinions of RBC Dominion Securities, Inc. All information and opinions provided in this video are in good faith, but without legal responsibility.
Brookfield Corp bought Oaktree in 2019. Is that right, Matt?
Correct.
Yeah. But Oaktree itself has been around since 1995, founded by Howard Marks. Howard Marks, legend in our industry, legendary bond fixed income trader, and somebody who I've read his memos many, many times over the years. If you ever want to read something really interesting or listen, you can Google Howard Marks and find his memos. I've sent them out before. Anyways, let's get started in the hopes of trying to keep it to 5 minutes, which we know won't happen. Matt, tell us about Brookfield Oaktree Wealth Solutions and what they bring to investors.
Yeah. Thank you, Greg. Thanks for having me on the call. I'll just build a little bit on that introduction of Brookfield Oaktree Wealth Solutions that you just gave. Before I know we talk a little bit about private credit and the benefits of investing in it. Brookfield Oaktree Wealth Solutions was actually formed in 2021 as a partnership between Brookfield Asset Management and Oaktree Capital. Now, while our specific group is relatively new, both Brookfield and Oaktree have been around for a long time. I'll start with Brookfield. Brookfield has an over 100-year history investing in and operating high-quality real assets. Think real estate, infrastructure, renewables, and private equity. Oaktree was founded in 1995 by credit pioneer Howard Marks, who you just mentioned a few moments ago. Oaktree is a global leader in credit investing. Now, in 2019, Brookfield acquired a majority interest in Oaktree to create one of the world's leading alternative asset managers and one of the largest alternative asset managers in the world. Today, we have roughly $1 trillion in assets under management. We have over 2,400 investment professionals and a footprint in 30 countries. Now, the goal of Brookfield Oaktree Wealth Solutions is to bring alternative investment strategies, which were historically only available to large institutional investors like pensions, endowments, and foundations, to individual investors.
So Matt, you're able to bring these newer types of strategies, alternative investments, as you call them, to many different investors now. Can you explain a little bit more about exactly what these alternative investments are?
Yeah, quite simply, if you want the literal definition of an alternative investment, it's quite simply a financial asset that falls outside of the traditional investments of stocks, bonds, or cash. This can include everything from hedge funds to commodities to liquid alternatives to more private strategies like private equity, private credit, real estate, or infrastructure. Now, all of these things have their own unique traits, but the common theme is that alternatives do bring a range of potential benefits, which include enhanced risk-adjusted returns, risk mitigation, income generation, and often inflation hedging. Most importantly, these alternatives should be a good complement to traditional stocks and bonds. Now, historically, these investments have only been available in structures that are really only suitable for those types of institutional investors that I mentioned earlier. They had very high investment minimums, long lockup periods, and virtually zero liquidity. It's really only been in the last few years that large investment managers like Brookfield and Oaktree have been structuring these investments to be more suitable for individuals with lower investment minimums, shorter valuation cycles, and monthly or quarterly liquidity. So this is a great opportunity for individuals to start to get exposure to these asset classes that have historically just not been available to them.
Right. You mentioned it before, and then just again now. One of the opportunities was private credit, and nowadays there's quite a bit of hype around these private credit opportunities. Can you elaborate more specifically on what private credit is?
Yeah, I mean, private credit, or direct lending, as it's often called, is simply a bilateral loan made directly between a lender and a borrower without the involvement of a traditional financial intermediary like a bank. These borrowers are typically private businesses that are founder owned, or they're owned by private equity firms. And they're looking to borrow money to assist with the growth of the business. Private credit has been around for a long time, but it really did begin to gain prominence following the financial crisis of 2008, 2009. After the financial crisis, increased regulation on the banks made it much more difficult and more expensive for them to lend to these private, small and medium-sized businesses. So a trend we've been seeing for some time is, the banks starting to step away from lending to these types of businesses, and private credit firms are really stepping in to fill the void left by the banks. So this is becoming a larger and more mainstream asset class. To put some numbers to it, today the global private debt market is about $1.5 trillion in size. That's projected to nearly double over the next 4 to 5 years, which will likely make it probably even the same size or bigger than the high yield bond market. So this asset class is going to continue to grow and is a phenomenal opportunity for investors.
Sure. So for investors, then, what are the exact benefits that they would see? Why is it so attractive to us investors?
Yeah, I mean, there are certainly many benefits. I'll focus on 3 of them: income, low volatility, and diversification. In regards to income, private credit generates very, very attractive income. Because these loans are private, they are a little bit less liquid. These can also be more complex and unique transactions. Because of this illiquidity and complexity, the loans do often yield a premium over what you would see in the public bond markets. In regards to volatility, again, these are private loans. These are not public. They do not trade on public exchanges. That makes them much less affected by things like market beta or investor sentiment. And then for the diversification side, private credit has a low correlation to publicly traded stocks and bonds, which makes it a really, really good stabilizer for client portfolios. So, to kind of sum that up, investing in private credit will really just help investors avoid the volatility of public markets while generating good income and compounding in value over time.
So that's all great, Matt, but let's be honest, there's no free lunch in this world, and nothing comes without a commensurate risk. What type of risks can you see out there for clients that enter the space?
Yeah, I mean, there's many risks to consider with any investment. The 2 I like to kind of focus on with private credit would be credit risk and liquidity risk. I'll start with credit risk. Like investing in any fixed income security, this is the risk of default. It's the job of any prudent credit manager to sort out the good borrowers from the bad ones. When it comes to investing in credit, your only upside is the interest you earn and the principal you're owed on the loan. It's not like investing in stocks where theoretically your upside is unlimited, right? So it's our job to minimize any losses we might have. And if we're lending to the right businesses with the right terms, with modest leverage, we'll put ourselves in a position to do well. Liquidity risk is another factor. It's important to remember, again, this is private credit, not public credit. These loans do not trade on public exchanges, and they do have limited liquidity. So once we've made a loan, we are committed to it. Investors definitely do need to consider their own liquidity requirements and understand that there may be certain times when you cannot get your money back right away.
Good. All right. So then, why do you think it's attractive right now?
Yeah, right now is a very good time to be invested in private credit. If you look at the yields being paid on the loans within the space, they're very, very attractive right now. Loans in private credit are typically floating rate. So with interest rates elevated, the yields being offered are very, very attractive. As a lender, we're also seeing strong terms, good covenants, and protections on these deals. So these are all benefits that investors can continue to gain from. Now, obviously, the topic on everyone's mind right now is the recent Fed cut in the US. Now, we believe it's possible that we do see more of a soft landing scenario in the US, where interest rates are not cut quite as aggressively as people are expecting, or even as the market is pricing in. Say in the scenario, interest rates settle at around 3 to 3.5% towards the end of 2025. Those are still relatively elevated compared to the recent history. So, the key in this scenario will be to maximize income to drive portfolio returns without relying too much on, the long duration that would require more extensive rate cuts to really drive performance. And private credit is well positioned for this. Yields right now are in the high single digits or low double digits. As investors, private credit is paying you to be patient.
Okay, so there's a bit of a yield pickup. And quite honestly, the last thing you said with regards to the outlook on interest rates has been something that I've really started to change and evolve in my mind as well. And one of the reasons why I like this space and why we're having you on today is because we do think that, the thought of interest rates being cut significantly more is starting to fade. And even some risk of interest rates starting to rise. So we think there's opportunity within that. And, and I remind listeners and viewers that, 2 years ago, really one of the biggest bear markets in bonds ended basically in this spring and early summer. The sell-off in the bond market was significant. And is one that really is underreported. But that sell-off provides opportunity, and that's where we want to fill the void. And we realize that, we can't bring everything to everybody, and other people can, and how do we take advantage of it? So, I think it's interesting, this opportunity. It's not overcomplicated. There's basically two asset classes. There's either you're an owner or you're a lender. And in this case, you're a lender, right?
Correct.
Yeah. Okay. So, Matt, you haven't been on this before, and we know that what you have to say has to be very carefully worded, and we appreciate that. But we always like to hit people up with one last question as just a bit of a surprise before they go. And okay. So, my question for you, again, getting back to Howard Marks, and again, Howard Marks has written these memos for years and years and years. They are must-reads for serious investors as he looks at the marketplace. At the end of the year, does Howard give you an exam on his memos through the year?
He does not, no.
He does not, but I imagine that you must be up to date on his recent one?
I try to be. He's been putting them out more and more frequently than he has in the recent past. But you're right, Greg. His memos are typically must-reads, that's for sure.
Yeah. Okay, well, again, and if other people are looking to read Howard Marks, you can just Google him and they'll take you to his memos. You can listen to them like a podcast or read them. They are really interesting. I'm just listening to one today, actually. And, the one thing I want to remind people is, again, it's not overly complicated. this. When you break it down and keep it in simplicity, you're either an owner or a lender. And in this case, it's on the lending side. With interest rates the way they are, with the bear market the way we've come through it, we just think that we have to be open to opportunities and we have to always be learning. And so, Matt, thank you today for coming on board and helping us learn more about this.
Thanks for having me.
Right. Again, we hope everybody has a great holiday season. Please pass this around if you find somebody that'll find it of interest. Rob, thank you for your time in setting this up. And Matt, thanks for time spent with you as well. Take care.